Look at your retirement account today, and everything feels completely normal. Mainstream media headlines boast continuously about record stock market highs, booming consumer spending, and massive tech rallies, while traditional financial advisors tell you to sit back and relax. You watch green portfolio numbers flicker across your phone screen and feel entirely confident your financial future is completely secure. But while relaxed investors celebrate, something unsettling is happening behind closed doors. Deep inside the heavily guarded subterranean vaults of London and New York, thousands of tons of physical gold bullion are quietly departing. Armored transports are working constantly, shipping real metal out of Western vaults and delivering it directly to Eastern central banks. Official data from the World Gold Council confirms central bank gold buying just hit multi-decade highs. The core anomaly is staggering. Western paper contracts are trading at a massive disconnect from the actual deliverable physical metal. If your savings are sitting in a traditional bank or index fund, you are playing a game whose rules were changed overnight while you slept. To understand why the smartest money on earth is running for the exit, you first need to see what Wall Street is desperately trying to hide. Before we dive in, let me be completely clear. This video is strictly for educational and news analysis purposes, not personalized financial advice. I am an independent investor analyzing official data to protect my own personal wealth and capital. Every metric shown here comes directly from verified institutional sources like the Federal Reserve, the IMF, and the World Gold Council. Instead of corporate media noise, I am giving you an unbiased, purely mechanical breakdown of structural monetary reality. Now, let's bring this global phenomenon down to your household bank account. When you live in Texas, London, Toronto, or Sydney, global gold markets feel like abstract financial news. But central bank gold accumulation connects directly to what you pay at your local grocery store and gas station. Right now, as foreign nations trade excess paper dollars for physical gold, those unwanted paper dollars flow back home into the domestic economy. This mechanism expands the local money supply and relentlessly erodes your everyday household purchasing power. You fall into the classic middle-class trap. You check your banking app and see $50,000 sitting safely in savings. Nominally, your balance stays steady, but in real terms, that money buys vastly fewer goods today than 3 years ago. True inflation is running at 8%. We saw this exact pattern during the 1970s gold repricing. It triggered a brutal decade of stagflation that severely eroded traditional paper retirement wealth. If you think this is just theoretical macroeconomics, let me introduce you to someone living through this exact shift right now. Consider Mark. He is a 42-year-old operations manager living and working in suburban Ohio with a wife and 2 children. He has $85,000 saved across a savings account and a traditional target date retirement fund. Mark is the definition of responsibility. He works overtime, cut his subscriptions, and meticulously tracks his budget on spreadsheets. On paper, Mark is doing everything right. His financial advisor tells him his long-term retirement portfolio is completely on track. Then came his annual financial review. Mark felt a quiet moment of satisfaction, seeing his total savings grow by 6%. But when he opened his actual bills in the mail, a cold realization set in. His home insurance premium had jumped 22%. His auto insurance was up 18%. Basic groceries and utility bills were all dramatically more expensive. Despite his rising digital paper balance, Mark felt poorer every single week. He was making more money than ever, yet his household had to budget far more strictly just to maintain their baseline living standards. Mark represents tens of millions of hardworking professionals who trusted mainstream paper asset guarantees, completely oblivious to the silent, compounding tax of ongoing monetary currency debasement. That moment was Mark's rude awakening. He realized a fundamental truth that Wall Street never explicitly teaches retail investors. True wealth is never the digital number printed on a bank screen. True wealth is your actual command over physical real-world assets like energy, real estate, food, and commodities. When sovereign central banks continuously flood the financial system with unbacked currency units, your digital numbers can rise while your living standards plummet. Mark didn't make a mistake. He was playing by rules designed for a global financial engine that just snapped its driveshaft. Here's how that engine actually broke. To understand how this market snaps, you must first recognize the difference between physical gold and paper gold. Paper gold, traded on exchanges like COMEX in New York or LBMA in London, is simply a digital promise check. It is a financial contract representing metal that may or may not physically exist inside a vault. Think of the entire global monetary system as a massive game of financial musical chairs. For decades, Western financial exchanges have issued dozens of paper claim tickets for every single physical metal chair sitting inside official registered vaults. Official CFTC commitment of traders reports show that total open interest contracts routinely dwarf COMEX registered inventory figures. In fact, analysts estimate there are up to 100 paper claims for every single bar of physical metal available for delivery. For decades, this worked because institutional paper traders settled contracts using cash, almost never demanding physical delivery. But here is the dangerous flip side. If even a tiny fraction of those contract holders suddenly show up at the vault demanding real physical bars instead of digital fiat dollars, the entire paper system faces an immediate run on the bank. That run is already quietly happening through the Shanghai Gold Exchange. Buyers in Asia are regularly paying physical premiums of $50 to over $100 per ounce above Western paper spot prices. This massive price gap creates a lucrative global arbitrage mechanism. Traders buy cheap paper contracts in London and New York, demand physical delivery, and ship that metal straight to Asia to capture higher physical premiums. Western vaults are draining daily to satisfy Eastern demand. Holding traditional paper claims means holding paper IOUs, while sovereign buyers accumulate real physical metal with zero counterparty risk. When paper claims outnumber real assets by 100 to 1, all it takes is a spark to start a run on the vault. And that spark was lit by global governments. The mechanics driving this breakdown are not random. They form a compounding monetary doom loop, rapidly spiraling out of control. It all began in 2022 when Western governments officially froze over $300 billion of Russian foreign currency reserves. In an instant, global sovereign nations realized that holding digital US dollars or Western paper treasuries carried existential political risk. If you cross Washington or London, your foreign savings can be completely wiped out with a single pen stroke. This triggered an immediate geopolitical reaction. Sovereign central banks across the globe began aggressively dumping paper US treasuries. They shifted in favor of unfreezable physical gold bullion, buying hundreds of metric tons and storing it inside their own sovereign borders. That massive shift triggered the next stage of the doom loop, a weakening of structural demand at US Treasury bond auctions. With foreign central banks no longer stepping up as eager buyers, bond yields were forced higher to attract private capital. As interest rates spiked, the annual cost to service America's national debt crossed a terrifying milestone, blowing past $1 trillion per year. This created an inescapable liquidity trap for the Federal Reserve. The U.S. government cannot afford higher debt servicing costs. Consequently, the Fed is backed into an absolute corner where it will ultimately be forced to act as buyer of last resort, printing new money to purchase unsold government bonds and expanding its balance sheet through de facto debt monetization. This infinite liquidity injection inevitably degrades the true purchasing power of every paper dollar in existence, driving the price of physical gold to continuous record highs. We have seen this exact historical pattern play out before. For decades, the global financial system has operated on a foundation of paper promises. But beneath the surface, a tectonic shift is underway. To understand where we are going, we must revisit 1968 London. The gold pool was under immense pressure as the world questioned US dollar claims. The illusion of paper began to fail. Architectural stacks of US dollar claims started to dissolve and melt into heavy, shimmering physical gold bars. In 1971, President Nixon officially closed the gold window, ending the Bretton Woods era and moving the world into a purely digital paper facade. Fast forward to today. While officials publicly reassure the crowds with digital currency symbols, a different story is unfolding behind closed doors. Pallets of government debt obligations are being quietly swapped for massive amounts of gold bullion by central banks across the globe. Most retail investors remain distracted by digital screens and flashing ticker symbols, unaware of the structural shift happening in the shadows. The math is unavoidable. Compounding debt servicing costs are rising like a tidal wave, threatening to overwhelm global tax revenue buildings. This is currency debasement in action. It is like ink bleeding out of paper bills until they are left blank and worthless. We are entering Bretton Woods III, a world where power shifts from west to east, following the physical flow of commodities and gold. The data supports this trend. Reports from the World Gold Council show central bank gold reserves shattering historic record levels. On Wall Street, analysts point to 5% yields on treasuries. They focus on short-term gains while ignoring the long-term erosion of value. It is a choice between holding a paperweight on a sinking ship or boarding the golden life raft built by central bankers. The macro shift is clear. The world is moving away from debt-based assets and back to the ultimate insurance, physical gold. In a world of dissolving paper, only gold remains solid. Protect your future by understanding the bigger picture. Thank you for watching. You see, central banks are not trying to maximize short-term annual interest yield. They are solving for long-term sovereign solvency and counterparty default risk. A 5% bond yield is completely meaningless if the underlying paper currency loses 8% of its true purchasing power annually to debt monetization, or if your foreign reserves are frozen due to sudden geopolitical disagreements. Wall Street plays a short-term game centered on nominal quarterly returns. While sovereign central banks play a generational game focused on survival, asset protection, and true systemic security. They know paper promises can easily be printed into oblivion, but physical gold remains an uncancelable, independent store of real value. Now that you see the game for what it really is, the core question isn't whether the system changes, it is what you choose to do. Navigating this monetary shift requires executing a calm, calculated strategy. While passive spectators watch their savings melt away, proactive investors build a hard asset shelter. Here is a simple framework to assess your personal financial exposure today. First, conduct a complete liquidity and counterparty risk audit. Calculate what percentage exists purely as digital promises versus real assets. Historical precedents, like the 1920s Weimar inflation, demonstrate the risk. Individuals who held zero tangible assets suffered the most when paper systems recalibrated overnight. Second, evaluate your strategic allocation to real assets. Strategists recommend holding 5 to 10% in physical precious metals as insurance. During 1970s stagflation, portfolios with hard assets preserved purchasing power. The goal is not rapid speculation, but acquiring independent reserves with zero counterparty risk when paper fiat currencies face systematic debasement. Central banks struggle with escalating sovereign debt burdens. Global bond markets will experience severe yield volatility and sudden interest rate shocks. Carrying variable debt during an inflationary transition exposes your household budget to dangerous cost spikes that can rapidly overwhelm ordinary family income. Remember, this framework is strictly an educational tool to build market awareness, not customized financial advice. Always consult a qualified independent fiduciary professional regarding your specific financial situation. The window of opportunity to prepare before mainstream awareness catches up is limited, but taking action now restores complete confidence. Let's bring this entire picture together so you can leave this video fully prepared for what comes next. To bring this entire picture together, remember 3 core takeaways from today's investigation. First, Western paper gold claims are dangerously stretched over rapidly shrinking physical supplies. Second, global central banks are aggressively abandoning U.S. paper debt to secure physical bullion at record rates. Third, protecting your financial future requires auditing your counterparty risk and prioritizing real asset stability. Instead of being caught unprepared by sudden systemic monetary shifts, you can stay permanently ahead of global macro trends with this channel. If you want macro analysis that cuts through corporate noise, hit subscribe and turn on notifications right now. In our upcoming investigation, we explore central bank digital currencies and the enforcement of strict digital capital controls. Now I want to hear from you. Do you hold any physical assets outside the banking system today? Or are you keeping wealth stored in paper assets? Drop your thoughts in the comment section below, and I will see you next.